Yeah, thanks, Satin. On behalf of Centrum Broking, we welcome you all on Satin Creditcare's Q3FY182 results concall. From the management end, we have Mr. H.P. Singh, the CMD of Satin Creditcare, followed by other senior management teams, including Mr. Jugal Kataria, the CFO, Mr. Dev Verma, the COO, and Ms. Mansi Verma, the Head Capital Markets. Without taking much of our time, I would like to hand over the concall to Singh, sir, to kind of give his comments and brief through on the numbers. Over to you, sir.
Thank you. Good evening, everyone, and I think, I'll take you through our journey of the last quarter as such. So after clocking in 2 quarters of losses, we returned to profitability in September 2017. For the quarter ended September 17, our PBT stood at about 17.1 crores. And we have, in fact, doubled our PBT for the quarter ended December 17 to about 34.3 crores. This quarter, in fact, we have made an extra provisioning over and above the RBI requirements and the norms to the tune of about 16.9 crores. And in spite of the provisioning being done in this quarter, our consolidated PAT for December 17 quarter has gone up by about 92% quarter on quarter to 21.6 crores. If you look at the last 2 quarters, our PAR 90 numbers have in total gone down by about 158 crores, of which the last quarter we had about a 61 crore recovery in the PAR 90 numbers. Now moving on from the PAR numbers, our disbursement for standalone 9 months for the year 2018 is at about 3,599 crores, which as compared to the full year of FY17, the disbursement was close to about 3,594 crores. And on a consolidated basis, our AUM now stands at about 4,881 crores, which gives us a growth of about 31% year on year and about 9% on a quarter to quarter. Our AUM growth over the last 9 months is 20% as compared to FY17. And based on this, we are on track to fully meet our guidance for March 18 of 5,500 crores. The other point where we, in terms of our portfolio, the concentration of the UP state for us has gone down by about close to about 2% from the September quarter. The percentage of the UP quarter of the UP state now stands at about 34.7% as compared to 36.9%. And taking a few forward, I think, technically around January end or so, we have close to about 33% as our percentage in terms of our concentration in UP. Moving on to our tech space, cashless disbursements are also now increasing on quarter by quarter basis. We were at about 26% by December 17. We currently at January end, early March, we are standing at about 30%, so an increase of another 4% from there. And our guidance for the next June 18 numbers is that we'll be about 50% of our portfolio will be through cashless disbursements. Reiterating our fact of the newer disbursement happening after demonetization from January 17, we still stand at 98% collection efficiency from there on. And this, in turn, represents close to about 84% of our total portfolio as of now. We have raised capital in the 9 months close to about 440 crores or so, in which Tier 1 was about 360 crores and Tier 2 was about 80 crores, which gives us a capital adequacy of 26.60%, wherein Tier 1 stands at about 22%, and Tier 2 stands at about 4.64%. In terms of our license, which we got for housing finance, we got our license in November 2017. We've, in fact, disbursed our first loan in housing finance on 7th of February 2018. And for us, as a business model, our vertical will probably be focusing more on the rural micro housing space. So that's the niche which we are trying to develop in our housing finance space side. On the tie-ups which have happened across in the last 6 to 8 months, we tied up with Capital First for our non-microfinance products. And we started the pilot during Q3 of FY18. We are incorporating a few learnings of ours from the pilot, and we are aligning our process and systems going forward after having done the pilot across over there. And the good news about the tie-up with IndusInd Bank is, in fact, we disbursed our first loan after integrating our process and system with IndusInd Bank today, and we are willing to take this partnership forward in microfinance space also. So these are the opening remarks across over there, and we open it up for the question and answers from all the people across over there. Thank you.
Thank you very much. We will now begin the question and answer session. Any participant who would like to ask a question, please press star and 1 on your touchtone telephone. If you'd like to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have a first question from the line of Manish Oswal from Nirmal Bang. Please go ahead.
Good evening, sir. Great set of numbers and congratulations to the entire management team of Satin.
Thank you.
My question on the collection efficiency number in this quarter, it is 98%. When I look at the performance of other microfinance players in the quarter 3, there is a meaningful improvement of collection efficiency, whereas in our case it is flat compared to the September data to December data. So could you comment on the same? And secondly, of our total 16% of book, which is vintage book, old book basically, on that 9.2% already NP and 6.8% is standard book. On that, what kind of collection efficiency we have?
See, I'll tell you something, if you want to do a comparison with our peers, I think you will have to go back into the history of demonetization and look at the comparison of how we have probably come out of, I think we gave it in our last presentation that we were about 75% impacted as compared to the others, in terms of our impact. We were probably 3 times much more than what our peers would have been. So I think, if you really look at that from that angle, you'll have to give us probably some forbearance in terms of the difference between maybe a 98% to maybe a 99% as compared to our peers or 99.5, So that is something, which you will probably have to stand by for some short period of time where we are disbursing again in the same impacted territories as such. So that's probably the call which, slowly and steadily will be probably be increasing as we move forward across over there, That's one. And in terms of our, I think if I've heard you correctly, in terms of our 16% or whatever it is, I think, we've probably been able to provide in terms of, we don't have comparison, but I think off the record we have comparison across. We provided on a basis that we provided close to about 62% of our GNPA has already been provided across over there as compared to maybe our peers someone who's done about 67 or 75. So I think, it's far more comparable in terms of, if you look at the thing over there. Our net NPAs technically are close to about 3.67%. I think, we are still in the work in process mode. I think, it's been 1 year, 2 months since the time we probably arrived at, by recovering close to about 159 crores across par 90 in the sector. Another 6 months, probably is the right frame or the right time where you can probably judge where this is all heading on to. It will take a while before it finally comes across over there. So moving across from, technically a 50% collection efficiency and, par 1 of about 50%, coming down to that, I think, it's a question of process and a question of time before it finally settles down.
Sure, sir. A second question on the recent commentary by one of the players for the MP market that the collection efficiency and the trend in the MP market is somewhat depressed. And so what is our experience in that market? And secondly, recently the Rajasthan government announced loan debt waiver. So we have exposure of 3.6% to the state. So how do you see the impact on the collection efficiency and MP and credit cost because of that development?
See, I think, again, what we have to really understand, these things go up and down. Technically, you are right to a certain extent that, yes, in the last, probably if I would say last 15 days or so, maybe the MP market is a little depressed. But then you have a lot of factors which actually roll in. I think, there by-elections would be coming in. There are rallies which are going on across over there. It does get impacted in the short term. But if you really look at it, I think, probably we'll have to wait for some more time before you really look at it. And my own sense is that, nothing as bad as what Demon could probably bring in. So once you come back from, maybe as I told you, from a 50% to down to this, I think, this is now all work in process, which will always happen. And we'll keep on the journey of trying to bring it back into, the system and try to work on the collection efficiency. But yes, certain pockets will definitely be depressed at some point of time. Certain pockets will probably go up. And in terms of Rajasthan, I think, after the loan waiver has been announced, I think it's been about 2-3 days. We've not seen any kind of a depression in our Rajasthan collections. As of now, we don't see anything, which is there in terms of the by-elections coming up or in Rajasthan.
Okay, and how much we have built for book for the Capital First non-MFI products till date?
We've done a pilot, that's what I said. I think we're, learning from the pilots are coming in based on our process and integration which is happening. We've logged in a few numbers for the two-wheeler segment, but it's getting integrated. So whatever learning we have from the pilot, I think we're taking into Q and working out and thrashing it out with them. I think, the scale will start happening once this is all done. So, it takes a while before all these processes get integrated. So maybe another a month or so before it finally takes up shape and starts scaling it up from there.
Sure, sir. And one small data point, what is the cost of funds on an average and a marginal basis in Q3 compared to Q2?
So marginal cost of funding is roughly 11.75% or so. The blended cost is still slightly high, but we are getting most of the sanctions between 11.25 and 12%.
So versus Q2, sir?
Q2 marginal cost of funding was about 0.25%, 0.3% more than where we are today.
Because the market rates have moved up, so I thought there should be some impact on us. But
no, so the rating has been slightly revised from BBB plus negative outlook to stable outlook. So that also has some impact. So the marginal cost has improved by roughly 0.25, 0.3% in this quarter.
Okay, sir. Thank you very much and all the best.
Thank you.
Thank you. A reminder to our participants, if you'd like to ask a question, please press star and 1. Our next question is from the line of Nagraj Chandrasekhar from Laburnum Capital. Please go ahead.
Hi. Thank you for taking my question. Congrats on a good quarter operationally. Just had a question on the securitized portion of your book. Now, this has started building up again. So what would you like to take it up to, say, over the next 5 quarters when you have that 5,500 crores March 2019 guide, just so we know how to model this out?
So I think there's a correction. The 5,500 consol figure is for March 18. Not for March 19, So by March 18, we'll be crossing that because we're already at 4,880, close to 4,900. So that's the number we have. But on the securitization, I think you will,
So, securitization portfolio has started growing. We are getting good traction there. There's a lot of demand because of annual closing, etc. So historically, we have touched a high of 25-30% off-book portfolio. With IndusInd now taking some shape, I think over a period of time, some 35-40% book is going to be under BC arrangement for IndusInd. And we'll prefer to do another, 15 to 20% securitized or assigned book, and balance will keep on book is the broad thought process right now.
Okay. And then secondly, on collections of past due loans, you've again done a good figure of 60 crores this quarter, bringing it down on top of the 100 crores you did the last quarter. Just wanted your sense of what you can get over the next quarter and what sort of write-off we're likely to see in a sort of an updated view, you'd mentioned a 150 crore number in the last con call, just where you think this number will end up now and when you'll be taking it. Thank you.
See, I can hazard a guess right now to give you probably, where the numbers will probably move in, but I can probably give you an insight that, it's now the hard task, which is there. So the last final bit which is left in terms of our unprovided portfolio, if you really might call it up as that, and which is our net NPA. This bucket is going to be slightly tougher than what we had probably done earlier. But still we are confident enough in terms of this thing. It could probably take and scatter over the next 2 quarters as such, but since we were able to bring it down, in fact, about 160 crores across over here, our whole endeavor is to move down, and bring it down further. Just to give you a very small example, we brought down our zero collection client from 81,000 to about 62,000 across. And if I give you probably the insight of my last week's number as such, so that 62,000 has come down to about 57,500 or so. Now the journey is going to be a little tougher, where it's going to be, maybe very small things, which will probably move across in terms of our collection. But the point is that as a management team who has worked relentlessly for the last 1 year and about 2 months or so, we brought this down, and I think, going forward, I think, we'll probably be bringing it down much further, But to be very honest, I don't want to hazard a guess or maybe set on any kind of expectation, but the thing is that we're working on it, and definitely there'll be positive results,
Thank you so much.
Thank you.
Thank you. Next question is from the line of Kashyap Javeri from Emkay Global. Please go ahead.
Sir, thank you very much for the opportunity, and congratulations for quite commendable turnaround. I have 3 questions. One on your margins. If I look at even adjusted for interest income reversal, there seems to be some squeeze on margins Q on Q. So what could be the reason for that? Question number 2 is that we had about, it looks like we had about 60-70 crores of recovery in this quarter, but interest income reversal is just barely about $1 million or so. So why would that be so low? And third question is that if I look at PAR 1, that's coming quite dramatically down, but in terms of PAR 30, there is still it's pretty slow turnaround. So how should one look at that?
Well, the first 2 questions Jugal will answer. I'll give you the answer for the third one,
Yep.
On the margin.
So, on the margin front, there were some delays, etc. also, though we are recovering the amount, so to that extent, there's some pressure on the margin. But as on the new portfolio, getting almost 98% of the collection, we have broadly priced our product at roughly 9.7-9.75% margin as against 10%, which is permitted. This because of some delay in collection, that the margins are slightly increased, but as the overall collection is improving, with a lag, we have collected almost 90% December and about 94% is. So as that gap is reducing, I think these things will be corrected.
And I think on the PAR 1 and PAR 30 numbers, I think if you look at the last 14 months as such, technically if PAR 90 can come down, which probably in the earlier avatar, I think it never used to be the case. If you really ask microfinance pundits across the whole journey, as such, they'll say PAR 90 is non-negotiable, you'll never recover it. But for us, we've still been able to recover that. So my own sense is, I think, if you look at the relevant, PAR 1 numbers, as long as they start coming down, I think that's a happy trend and that's a positive trend to look at. And my own sense is, I think PAR 1 and PAR 30 definitely will take a while before it finally registers into probably, maybe new numbers. If I give you a figure of bringing down from a 11.43, I think our PAR 90 came down to about 9.17. And PAR 30 would be, I think it is close to 12% across. Yeah. So it will be there. My own sense is that I think, as the demon, level starts going down, the credit cultures will start coming back, and it has started coming back. But give it a time before it finally settles down across over there. It was a big event. It was completely a black swan in our whole history of our life. And the discipline is finally coming into this thing across over there. And just to give you one more cue based on that, we also track our attendances across there. The attendance across in center meeting is registering a significant improvement in terms of there. If I give you my demon figure, my attendance had dropped down to about 50%, That has now jumped up and come down to about 85% or so, which was also slightly a notch below the levels which we had it before, So I think, that's a relevant trigger point which we really look at. I think, our numbers will follow suit after these attendances.
Okay. And just a last question on this, credit cost in PSL. How do you see that, moving? So let's say in Q2, that number was, in terms of credit cost about 3.2 crores. This quarter it again went up to about 4 crore. So how do you see that, panning out?
It's a small one as compared to our larger portfolio in Satin. The only thing which is probably holding us over there is the reluctance of some of our borrowers, partner banks, probably giving in, products or maybe lending again in the impacted territories. And that has probably been our biggest drawbacks in terms of our recovering our old portfolios from our existing clients, because if we don't give further fresh loans across in the same territory, definitely, I think, the whole process goes for a toss, In fact, that's probably one of the reasons why we've been talking to our partner banks across, and a few of them have given products now basically to do more this thing. So you'll be seeing more positive numbers coming now on as we got the products from our partner banks to move across over there.
Sure. Thank you very much, sir.
Thank you.
Thank you. Our next question is from the line of Ramesh Ramchuri from Sign Capital. Please go ahead.
Good evening, sir. Excellent numbers for this quarter. And as you promised, post the September results, most of the pain has been gone through, whereas some others are still feeling the pain, as one of the speakers previously mentioned. I have two questions. One is on the MSME book, particularly, since the MP question has been answered. And second, I find, the excess interest spread which you're booking as income, which is interesting because since you're rated BBB plus, if I'm not mistaken, if you could pass on some of that, you would get a better rating and probably be able to borrow at a lower cost. That's number one. And second, as regards MSME and housing, in affordable housing, we have lately observed jump in credit costs or, almost 5 times normal home lending rates in terms of default rates. And number two, the MSME, the segment is largely unorganized. And with other MSME players, we have seen stress, particularly as GST is rolling out and the unorganized players are being pushed to the organized players, organized space, So any observations on both these? How are you going through this and what has been your experience?
So if I give you an answer to MSME first, see what we are doing in the MSME space is one, it is all secured technically. So we're not doing anything which is unsecured in the MSME space, which gives us again a breather in terms of our portfolio quality and the collateral which we probably are taking in the segment. Secondly, we are not gunning for technically numbers in this thing. We are probably focusing more on quality than on quantity in our space of MSME. We've seen impact of GST and all in the unorganized sector, but I think we've seen that in the microfinance sector also. So once we've been able to navigate that in the microfinance space, and since we are new entrants across in the MSME space, we probably will have more bandwidth to actually choose our customers to actually bank with us and, do this whole project. So that's two. There are a couple of initiatives also we're trying to do in MSME, which probably I will not like to speak on this. I think, maybe over a certain period of time, I think we'll be able to unveil and give it to the outside world. On the housing space, affordable housing, yes, you are right. I think we also read it across that the credit cost in terms of the portfolio is going up across in the space as well. We are building again our niche in a very different segment as such. So we are building up our niche, as I had mentioned in my opening call. This is the rural micro housing segment which we are looking at, where technically, again, the collaterals, the peer pressure, the whole environment is still not as bad as what has been there in the normal affordable housing segment. So that is what our niche area is going to be. And I have reiterated again, in several of my, conversations with the people is that this is probably the area where a lot of people still have not been able to enter. And we've done pilots, we've done complete work on this for the last 1.5, 2 years with Reliance Capital, and we've got huge learnings on this, So we know that we'll be able to build up a much better portfolio quality in terms of whatever our peers in the affordable housing space is there, So this is what I queue for the housing space is there. And in fact, I think the third question, can you just repeat it again, I think we were not able to get that correctly on the PSL something.
No, sir, the third question I was basically looking at your IT capex. Is it over, and are you seamless from end-to-end tablet to, your central processing?
I will just leave you with one possible thing across over here, that our IT system, which has been developed in-house, in fact, if you look at the capex which we have would have spent by doing an in-house as compared to whatever we were trying to do the out-house with an agency across over there, building up a software, we've been able to serve, we've been able to actually lessen our cost by at least about 30-40 crores, So that's number one. Secondly, I think, from where we look at it, it's an end-to-end solution which we've built up. Probably the only ones, I think, to whosoever we showed our dashboards and across over there, we live every 2 minutes in terms of our collections, which I think probably is one of the first in the MFI space, And we're taking these learnings to our MSME, our Tarashna BC book. We're taking this to our housing across over there. So we will technically be far more deepened into the way we're bringing in technology for our company. So I think, we've probably done a huge job in the technology space, and we can look at much better things coming up in the future also.
Thank you, sir. Thank you.
Thank you.
Thank you. Our next question is from the line of Amit Premchandani from UTI Mutual Fund. Please go ahead.
Good evening, sir. Thanks for the opportunity. I just had a question on the...
Mr. Amit, your voice is not audible. You need to speak up.
Sir, I just have a question on the Capital First tie-up. Now, the Capital First is kind of under agreement with IDFC Bank to kind of merge. How does it impact the tie-up with Satin going forward?
I think up till now, whatever feelers we've got from Capital First, and I think Capital First would be the right guys to really answer that. But, if I can answer on their behalf and I don't get sloshed by anyone from the Capital First side, the indicators and the feelers which we got from them, they are far more interested now to take this journey on a bigger platform across over here. And that's the only thing which we've been able to get at. In fact, our exercise with them on the pilot and everything is going along still over there. There's been no stoppage on that. And hopefully, I think, it'll be far more a bigger tie-up than what it was earlier. I think I could probably just leave it at this, right now.
Thank you, sir. That's it from my side.
Thank you.
Thank you. Next question is from the line of Gautam Jain from GCJ Financial. Please go ahead.
Hello, Mr. Singh. Congratulations for very good numbers.
Thank you.
I have a couple of questions. One is our loan book guidance was 5,500 crores. Is that intact? I joined it late, so maybe questions are repeated.
5,500 crores. Guidance was for 5,500 crores for March 18, yes.
Okay, and the margin for this quarter sequentially is down a bit. So what was the reason behind that? Even after raising some capital, the margin was down.
Those are, shall say, quarterly numbers and all. We are broadly working on 9.75% margin, and then since there's some delay in the collection in the past and also and even in this quarter, and then we are collecting only 98% of the amount on the new portfolio. A combination of all these sectors is temporarily impacting the margin, but as we are moving along, the collections are improving. Since we have priced our product with 9.75% margin and the processing that we are getting, so we'll start getting those kind of numbers going forward.
Okay. So collection efficiency on new loans which are disbursed post January 1st, our overall collection efficiency is 98%, which is the same as it was in Q2. Other competitors have more than 99.5%. So are we seeing some improvement from 98% going forward, or can you give some guidance on that, on 98% collection efficiency can be improved from here, or we should assume that there will be 2% credit cost going forward?
I think we'll improve from here, definitely. That's what it is, So this is just the start after we disbursed. And as I told you, and I think, the baseline has to be understood that we still have the top 5 states of ours, which, comprise of 75% of our portfolio are the impacted states. And we are disbursing again in those states across over there. And probably if you give us that benefit across, that we've still been able to match up, so there's a difference of 98 and 99.5. My own sense is, I think, if you really ask me personally, I was hoping for something, less than that, but it has given us a huge confidence that even in spite of the fact that new disbursements post-demon starting January has still been able to nurture up to 98. Our endeavor definitely is to, come up to a level where it will be definitely be much more than that, That is for sure. But it is a process-driven thing. It will take some while before we are able to do that, but definitely I think we'll probably be able to achieve it,
Can you provide some guidance on credit cost for next full year, FY19? Maybe in the range?
If I give you my own and the team's this thing across over there, it'll remain within that range of 1% or so, not more than that.
Okay, that's very good. Thank you so much. Thank you, sir.
Thank you.
Thank you. Next question is from the line of Deepak Podar from Sapphire Capital. Please go ahead.
Thank you very much, sir, for the opportunity. Now, sir, my first question is over next 2 to 3 years, you have a MF book and now you are going aggressive on non-MF book as well. So how do you see that mix changing over next 2 to 3 years?
I'll give you a horizon for the next 5 years. That's what we built into our whole, exercise of looking at how does non-microfinance and how does microfinance look at. So based on, our calculations across over there, I can give you just a fair assessment that in the next 5 years, the mix will probably be 2/3, 1/3, So 2/3 would be microfinance and 1/3 would be all other products, which would be non-microfinance. So that's what we are technically looking at. It could be a little better than that, but this is definitely what we are trying to achieve in the next 5 years.
Okay, 2/3 and 1/3. And as a product, can you give some sense that what sort of ROA your non-MF book can sort of generate versus your MF book? So some comparison between MF and non-MF book on ROA front.
I think it's if you really ask me for the non-microfinance, I think it's slightly early to, probably project that. But our own sense is if you look at maybe on a consol basis, we are trying to achieve maybe 3% ROA in the coming future as such.
3% ROA maybe next 1 to 2 years is what you are saying?
Absolutely.
Okay. Okay, that's it from my side. Thank you.
Thank you.
Thank you. Our next question is from the line of Abhijit from Kotak Securities. Please go ahead.
Good evening, sir. The first one is the observation on your client base in the microfinance business. So it appears that it has more or less been stable over the last 9 months at around 2.3 million. Just wanted to get this. There would be some movement in terms of the older ones going off and acquisition of newer ones. So how has that changed over the last 9 months or so?
So what we've done in our impacted territories is that, in certain pockets, we are not looking at newer clients. We are servicing our older and good clients across over there in there. So that's the reason why I think, probably the increase is not in these impacted territories, which was our major territory. And the new states and the new territories which are coming up are doing, an increased portfolio for there, and it's all settling down and negating and coming onto the same level as such, in terms of this thing, And in fact, if I can say our loan, this thing, is also slightly increased in terms of this thing. If you're talking about the numbers of clients, that's what you're talking about. Hello? Hello?
So we've lost the line for the person. We take our next question. It's from the line of Mr. Alok Shah. Please go ahead.
Yeah, sir, I had a couple of questions. While we've been talking about 5,500 crore AUM for FY18, is there any assessment done for FY19 and maybe, FY20 as such? That was my first question. And the second one would be more from looking at the state concentration. While UP portfolio has been coming down, we've done great inroads into territories like Bihar, West Bengal, Assam and Orissa. How do the states look like, and also from the competition point of view, how does things shape up here?
So Alok, I think, if you look at the overall FY19, FY20, I think, the overall, I don't want to give a guidance, but I think, we're looking at a growth of at least about 35 to 40% overall in 2019 and then 2020, from where we look at this. So maybe a 40% growth is what we are looking at in terms of our AUM if you go forward. In terms of our concentration in the space, UPS has come down. Our ultimate thought process is that, we would not like to have any state go beyond maybe 18% or so. Our benchmark, we've keeping it as that no state goes beyond 17 to 18% in any possible form. And that's the reason why we've been able to open up and scale up in states like West Bengal, Assam, and Orissa, and, a couple of other places. I think, we're looking at opening up 2 more states in the next financial year as such. So that's what our thought process is. So definitely, if you look at the mix around coming across, that this is how, it is ultimately going to pan out to be. And in terms of competition, I think, our own sense is, people that nobody has the heart now to do disbursement in UPA excepting us, So, we still stand tall across over there. And if I really want to work across over there in UPA, I can still do it, But that's what I sense is, I think,
Sure. Maybe just a continuation to your part, your answer to the growth of 35-40%. So what will be the level of tier 1 that we will be comfortable, beyond which we would actually go out for some kind of new equity raise? I mean, the capital that we have is definitely sufficient enough for at least 6-8 quarters. But any tier 1 number, also considering the rating agencies' thought process on, the multiple factors that they keep on arguing with us.
I think the rating agencies and us, we have different tangents, when you really look at, So we are always, as a financial services company for the last 27 years, we've always worked on lower, tier 1s and across over there because, leverages is the most important factor in financial services. That's what I've learned in my life, But anyway, looking at what the peers bring on and, looking at rating agencies, other possible stakeholders in the environment. Our own sense is that, I think, if you look at 40% growth rate along with the profitability figures coming in across over there, I think we are fully set to at least register a 35-40% growth in the next 1 year or so. We'll see how it pans out to be, and if we think that we are able to achieve much more than that, definitely then if it needs maybe a capital raise 1 year from now, we'll definitely look at it. But our own sense is that we are good to go for the next at least 4 to 6 quarters, at least my bare minimum,
Sure. And the second part to my question was, you talked about moving into 2 new states. We kind of are heavy, majorly focused into Central and North India and now to the Northeast. Are we kind of really looking at South India for now, or that's still going to be some time away?
Earlier than long enough, I think we will probably look at, maybe a couple of South states also, and cherry pick out from there,
Sure, that's helpful.
Thank you.
Thank you. We'll take the next question. It's from the line of Jeevanathan Manivasagan. Please go ahead.
Hello. Yeah. Good evening and congratulations for the good set of numbers, sir.
There have been no dividends from the company since listing. Is there anything regarding dividend policy, sir?
Dividend?
Yeah, dividend policy.
I think I haven't heard of dividend for the last so many years across also in my life, and all whatever you generate is all for, growth, because that's everybody loves that,
Okay.
So my own sense is, I think, dividend is still far away from that life, and let's see when we are able to do that,
Okay. Yeah. Thank you, sir.
Thank you. A reminder to our participants, if you'd like to ask a question, please press star and 1. We'll take our next question. It's from the line of Kashyap Javeri from MK Global. Please go ahead.
Thank you very much for the opportunity. Continuing with, Alok's question on this geographical diversification, what gives us so much comfort on some of the states which we entered just in about FY 16-17, and we have seen dramatic growth like, Assam, West Bengal, to some extent, if I look at on quarter-on-quarter basis, even, something like Bihar has grown like quite dramatically, 14%. So this East and Northeastern state, what's the comfort that we drive in this portfolio? That's one. And question number 2 is that, it's the rundown or not rundown, but reduction in proportion of UP portfolio is quite commendable if one looks at slightly longer term. But given the recent past or recent experience has not been that great in demonetization, that's still like about 34.5% portfolio in December 16 versus just about 34.7% in December 17. So if I look at quite near term, it's not gone anywhere actually.
Please understand, what UP consists of. If you really ask us, if you go by micrometers, the penetration levels are still so low in UP that a 34%, whatever it is, doesn't do justice to the type of demand which you have in UP. It's only because the environment talks about it. I think the external stakeholders, rating agencies, everybody, my own sense is, I'm maybe more of a conventional, person to really look at. But in terms of demand, there's absolutely no way that you can match up the demand which is there in UP. Having said that, I think, it's more to do with not really that we are at the same plateau, 34.7, we increased to 38% also across over here. And if we talk of figures of a couple of our competitors, some of them have 40-50% in one state, and, there's probably someone who works only in 4 states and they have 100% portfolio across over there. So it's not that we can do far more in terms of our numbers, profitability across if we just remain in UP and make it into a large portfolio of ours, but ultimately geographical concentration definitely goes for a toss across over here. So I think, for us, we'll be able to do far more justice once we are there completely pan-India. When we take up southern states also across over there, we'll do more justice in terms of a higher portfolio, higher AUM. We'll be able to bring down the percentage across over there. So in terms of numbers, I think it'll still be the same, but in terms of percentages, it'll definitely go down. So that's what way we are looking at. East, I can only give you one answer. Somebody who's worked in North and Central, and as a team, if we've been able to negotiate UP and all this, I think East is not too much of a problem for us. So for us, our learnings are existing across in UP and everything, hold us in good stead to do much better than anyone else in these territories. So that's the only reason why we attend. And diversification, that's the only answer which we have,
Okay. Thank you very much, sir.
Thank you.
Thank you. Our next question is from the line of Gaurav Jani from Centrum Broking. Please go ahead.
Yeah, thank you for taking my questions and congratulations on a great set of numbers.
Thank you.
Firstly, sir, on the OPEX part, so this quarter we have actually, seen a bit of escalation in the OPEX expenses, meaning the employees' expenses and the administrative expenses. So anything to read out there? I'm sure we have added about 48 branches. So apart from that, anything else?
No, primarily the same. We recruited almost 1,100 people in the system, opened 48 new branches. So just preparing us for, growth for next year and all. So there's a slight increase temporarily, but as these branches will take much better shape and all that, the portfolio will grow, the OPEX will be corrected.
Okay, because even if I see the administrative expenses on a QOQ basis, it's up about 25%, so nothing specific, right, out there?
So nothing specific, more number of branches, some regional offices, and the staff are the major contributor of increase in OPEX. But as they start building a portfolio in new branches, this will even out over a period of time.
Sure. That's number one, sir. Another thing is, when I look at your NNPA portfolio of about 3.74%, which is about 150 odd crore. So what's the sort of a recoverability out there going forward, in probably the next quarter and probably the next few quarters? Would appreciate that.
Gaurav, I think, as I told earlier, I think, this is now the hard one which is left. So we are trying all our level best, and I probably, in terms of, I will not like to hazard a guess, but my own sense is that we are doing whatever we can possibly do to bring, this down to level where we are over to say that, okay, fine, demonetization done and dusted. But you'll have to give us maybe a couple of more quarters to bring it down, and I think we're working on it. What figures will eventually, emanate from here, I think it'll be a happy figure, I think it won't be something, which could probably, do this. We've been able to do it last 2 quarters. I think we'll be able to do it in the further quarters as such,
Sure, sir. Appreciate that. If I had to put it another way, we clocked about 60-70 crores of recoveries in this quarter. So can we expect this trend in the next quarter?
I won't hazard a guess right now, Gaurav. We are working on it, to be very honest. And as I told you, this would need probably far more time for us to, battle it out. But we'll definitely do that. The team is fully confident to navigate this, and I think they are well prepared to do this. Let's wait how we are able to do it. We've done an extra provisioning in December also to just look at things that are cost away. So it'll take us some more time, before we are able to finally finish off this last 150 crores,
Sure. Sir, last question, probably a bit a qualitative one out here. So just want to understand in terms of customer behavior. So typically most of the MFIs are concentrated or focused in the west or the south. So, as a player, how would you differentiate between customer behavior, say for example, in a west or a south region as compared to north or east?
So we have very limited presence, Gaurav, in West and no presence in South. So I think, for us, if we look at Demon, then I think, probably North and Central was far more impacted than anything, So if we pick up a state, I think, it was only Karnataka to a certain extent which was impacted. But otherwise, besides that, I think only Maharashtra and that to certain pockets were impacted, So I really will not have an answer onto that, but our own sense is that the only thing which is positive on our side is that since we've been able to bear the brunt of completely this event, we'll be probably be in far more better version to navigate any kind of geography now, probably to look at it, I think if you really look at it, West and South would be probably far more easier for us, if you really look from that standpoint,
Sure, appreciate that. Thank you so much.
Thank you so much.
Thank you. A reminder to our participants, if you'd like to ask a question, please press star and 1. Our next question is from the line of Manish Oswal from Nirmal Bang. Please go ahead.
Only one request. Last time we had shared state-wise collection efficiency trend. So could you put that information on the public domain for this month, or this quarterly performance, how the performance across the state, top 6 states?
I think we can probably look at it and see how we can.
The overall trends are positive, and then broadly in line with this, so we thought that will be repetitive. But broadly in all the states where we are giving the trends,
it's 100% and above,
Yeah, it's either constant or improving in all the states where we have been giving the trends.
So,
if you want it specifically, I think we can probably look at it, from a specific way. We can always.
Sure, sir. The only thing I need to understand is from the quarter 2 to quarter 3, any of the states where we see the collection efficiency trending down, or top 6 states?
No, I can give you that. There's no trending down from for any states.
Okay, sir. Thank you.
Yeah, thanks.
Thank you. I would now like to hand the call over to Mr. Alok Shah for closing comments. Over to you, sir.
Thank you so much for your commentaries. On behalf of Centrum Broking, we thank you all for joining on the call. You may now disconnect the lines. Have a great day. Yeah, thank you so much.
Thank you, everyone.
Thank you, Mr.